What's going on, y'all? Welcome back to the channel, man. You already know it's your boy Terry Reveal. Treating your hustle, helping you build your financial muscle. I'm a little down under the weather, but I'm gonna still try to stick through this video. Probably gonna be short. So what I want to talk about today is as much as I love investing into the stock market and I love watching TV shows or channels like CNBC and Jim Cramer show, you can't let that stuff affect you into the way you invest in the stock market. It's entertainment, and it's actually meant for companies who are not that well known to get out in front of people, to people know they actually exist. That's all a channel like CNBC is really for. People get on there, he talk about buy, sell. It's fun, and it's games, and you know, hedge fund profit off that stuff. So hedge funds really profit off that stuff. How does hedge funds really profit? If a company reports today, they reported a great quarter, they got a nice looking CEO come up, get interviewed by Jim Cramer, I'm pretty sure that stock is gonna go up a little bit tomorrow because it was a great presentation. Now, you being a hedge fund, how a hedge fund makes money, honestly, they hedge against themselves, right? So a hedge fund will use, for example, like $70 million and spread that across 10 companies, right? So 7 million in each position. And they're really trying to use that 7 million in each position to make 700,000. So to go up by 10% in each position. Now, if they succeed, right, they'll make $7 million across the board. But if they fail on certain points, they might end up leaving out with $5.4 million. But they're going to do that in 2 days because they're spread across all of these companies. They're hedging against themselves. That's how a hedge fund makes money. But for you to make money like that, you got to have a lot of money in the game. So when you lose 100,000 here, you're making 200,000 here. Right? When you lose 200 here, you're making 500 over here, you're making 300 over here, you're hedging against yourself. You're not really losing. But us as a retail investor, we cannot actually do that because we don't have the amount of money to hedge across all of these companies and keep track and do all of that. So the best thing for you to do is to play the long game. Long game is always going to work best for you because you're going to buy and hold a solid company. You're going to buy and hold a solid company, right? And you're going to make sure that the solid company has been producing a great return over time. And you're not going to let nothing shake you from selling the company or anything like that. If you buy a solid company like Apple, Amazon, Microsoft, Nike, Tesla, like some of these companies that I just named right here, you can make a portfolio with just those companies and never sell and just keep putting money in. That portfolio right here that I just named with the 5 companies, Apple, Amazon, Nike, Microsoft, Tesla, guaranteed gonna give you at least a 15% return year over year over year over year. The trick is you cannot buy or sell whenever Jim Cramer tell you to buy, sell. He's not talking to you, the retail investor. You know what I mean? You're not gonna make money like that. Because for one, if your portfolio not that big and you buying and selling consistently, you probably gonna end up paying more in taxes than the actual profits. Because remember, when you sell a lot of your stocks, once you get over $10,000 and you sell your stocks, you got to pay 40% to Uncle Sam. You don't really want to do that, right? So you want to buy and play the long game. You never want to get in a position where you got to sell early, man. So Jim Cramer, CNBC, that show is fun, man. But don't let them affect you in what you do with your account. Because that information is really meant for a hedge fund. Not us, the retail investor. Like, subscribe, comment down below, share the channel with your people, man. I'm under the weather. Catch me in the next one. I'm going.